Let's start off with the ANC NGC meeting and the fact that we saw interesting comments from Finance Minister Pravin Gordhan about a stable currency and, of course, that nationalisation is not government policy. Similarly, we also saw President Jacob Zuma talking about job creation and that monetary policy needs to allow for this. Your view on this and how it's going to impact the rand?
Hi, Eleni. Nothing new as far as current statements coming out of the NGC in any case. The rand market taking it all in its stride, although President Zuma has spoken about a more competitive exchange rate. Not a lot of detail as per usual and not a lot of statements about how this needs to be achieved. I think we're all of the same sentiment that the rand needs to be a little bit weaker across the board on a macro basis, but how do you achieve that in a global environment where interest rates are at zero, where equity markets are at best can be described as benign, and global investors hunting for yield at this point in time. And of course, that's what's driven the rand to the current levels.
Well, David, I mean, at the end of the day, if we do see some kind of intervention on the rand, we know in what kind of form it'll be. We know that the Reserve Bank has been accumulating reserves and, of course, US dollars as well. There's a lot of talk about Tobin taxes. That has, of course, been talked about not only at Treasury level, but, of course, Kasata also coming in with some suggestions. Down the line, how do you see the rand being affected? Because there's also a lot of leadership questions coming to the fore as well. Or do you think investors are going to put all this stuff aside and look at the fact that South Africa is offering great yield?
Well, Eleni, it's sort of well known that I've been waiting for some reaction from the rand because of the domestic sort of policy situation or policy debates that are going on. Global investors have ignored those completely as the years rolled on and simply piled on more and more positions in the rand. If one looks at the intervention debate or the accumulation of reserves debate, one only has to look at what Switzerland had to do to weaken their currency. More recently, Japan. We're talking about billions upon billions of dollars as far as intervention is concerned to weaken the currency or their respective currencies. Currently, the South African spot market is in the region of sort of 5 to 7, perhaps even a little bit higher than that, $9 billion turnover per day. Any sort of action that the Reserve Bank may take to weaken the currency is going to have to be a whole lot more stringent than they have done in the past.
Well, David, we saw the rand weaken slightly on Friday because we saw foreigners being net sellers of bonds at the end of last week. Do you expect this trend to continue down the line, or do you think we're going to be seeing a bit of a reversal?
I think it's not surprising that we saw some bond profit taking, but at the same time, we did see the dollar weakening and gold taking off, and those have been supportive for the rand. So bonds have weakened. The rand has weakened slightly against the crosses, more notably against the euro, but nothing substantial at this point in time. I don't think we're going to see further money taken off the table as far as the bond market is concerned. Particularly, if Finance Minister Pravin Gordhan is talking about 6.5% to 7% growth rates that are needed. President Zuma talking about employment that needs to be created. One of the avenues that are left over is perhaps interest rate reductions going forward. And of course that will be good for the bond market. So I'm not sure that there's a lot of steam left in the upside as far as bond markets are concerned, and the rand currently taking all of this in its stride.
Well, David, in comparison to the developed world, South Africa still has room to move on the interest rate front, so I suppose we should be grateful for that. Just looking at what President Barack Obama was saying last week, painfully slow growth coming through. There's a lot of talk about quantitative easing in the second round of that coming through, purely because they have really no room to move when it comes to interest rates to try and stimulate the economy. The dollar, because of all this talk, has started to weaken. Your view on what's playing out, and of course a lot of moves to try and ensure that the US does not fall into a double dip scenario.
Well, I think that sums it up properly, Eleni. The developed nations across the world, similar challenges to us, perhaps not as great on a percentage scale, but on an absolute scale. When you're talking about unemployment in the US and the size of the unemployment problem there, they're really scared that things head into a double dip there. So we certainly, we definitely have interest rates that are going to be on hold there for an extended period of time. It's debatable whether we get QE, a second round of quantitative easing. I think they will be pushed towards that level. Of course, that's all supportive for currencies like the rand that offer relatively high yields. And I think once the sort of policy debate around the General Council meeting with the ANC is out of the way and surmising that we don't get major policy shift coming through on that front, I think the rand will remain supported for a while to come, particularly when one looks at what gold is doing.
Oh, yes, exactly. This is my next point. Looking at gold hitting new all-time highs last week, and we just keep seeing it strengthen. We've got Goldman Sachs talking about a new level of around $1,300 an ounce. How likely is that is it going to happen purely because we have been seeing the deterioration of confidence when it comes to paper money, and because of all the talk about QE2, and then also looking at the debt worries that are still starting to emerge from the Eurozone as well?
Well, I think that's the entire point. If one looks at from Europe to the UK, to the US, Japan, certainly confidence in fiat currencies is eroding. I mean, it's nothing of a critical nature, but it is eroding, and that's why gold is enjoying such support. It's a hard asset. It's something that that you own. It costs nothing to finance at this point in time, and it really is enjoying a safe haven status. And of course, on a multifaceted front, that is supporting the rand as equity market inflows. As far as the gold price is concerned, that's pushing gold miners' revenues up. We're also seeing it as a potential reserve earner for ourselves. So it is very supportive for the rand. Of course, all that will dissipate very, very quickly if we have any muted direction towards the nationalization of mines. But I must say that I don't see that happening at this point in time, simply from a cost point of view. If you're going to reimburse all the current shareholders of mines, the fiscus certainly can't handle it. I think there's some prudent minds in the finance ministry, and it simply can't happen at this point in time.
An interesting article that I picked up on CNBC.com. We've been seeing strong investor demand coming through for junk bonds, and it's quite interesting that many investors are starting to track junk bond markets, and bonds sold by companies with credit ratings below investment grade rose last week above 100 for the first time since the start of the credit crunch. We've been seeing very conflicting views in terms of how much risk people are willing to take on. What is your view, David?
Well, as this hunt for yield continues, bearing in mind that the central banks around the world have put in so much liquidity into the system, and that liquidity, if they're not going to lend it to the corporates, that's going to earn 0% as it washes around the system. And so it's not surprising to me that there is a little bit of a hunt for yield as far as junk bonds is concerned, although that will, that hunt will take on a bit of a cautious tail, because arguably that's what's got us into the trouble in the first place with the subprime debt crisis. So it'll be on a selective basis, and I guess you can throw junk bonds into the same quotation as far as emerging market bonds are concerned. Higher yield, that's where the market is heading at this point in time, and that's what investors are looking for.